Well, investors watching developments in the Middle East while they await the Fed's decision on interest rates later today. In the meantime, Treasury yields are a little weaker. 10-year right now at 4.38. And joining us to discuss all of this is Komal Sri-Kumar. He is the president of Sri-Kumar Global Strategies. Sri, let's talk this through. First, maybe what you think the Fed is going to do, and then we can get to what you think they should be doing. You think that nothing's going to happen today. In fact, they're going to drag their feet for as long as possible.
I think that's what is going to happen. You're talking about whether it's going to be October or December before they cut rates or decide to do it, Becky. Today, there is nothing. So two things to watch for. What does the dot plot show? Essentially, for markets, I think the dot plot is eventually meaningless. They can say 2 rate cuts coming in 2025 and they don't have to change it, but the market reacts to it. So it's important to watch. The second thing would be what happens with Jerome Powell's press conference at 2:30 p.m. Eastern and how he handles the question of not having cut interest rates with the president demanding a full percentage point cut in rates. And how does he explain what he and the other members of the Federal Open Market Committee are going to do during the rest of the year? Those are the things to watch.
Let's get to what you think is going to happen. Most of the world is waiting to see when the Fed will cut rates. You think they need to be raising rates. Why is that?
I've been saying that for a while. And if you look at what is happening today, you have the higher oil prices pushing up inflation. I think the tariffs are going to have their impact on inflation during the second half of this year and the first half of 2026. And it would be irresponsible to cut interest rates now when you don't know what the impact is going to be. Somehow, the Fed has been saying, based upon all the public speeches they make, that uncertainty means stay put. Why doesn't uncertainty also involve being more cautious? Increasing the interest rate and preparing for a higher inflation.
Well, to this point, nothing has shown up. Anyone who's been waiting for those numbers in inflation has been surprised to not see anything to this point.
I have been writing and saying that there will not be any show in inflation in the short term. The reason being wholesalers, retailers are taking the cut themselves, reduce their profit margin. And they are postponing the date in which they need to pass on the cost increases, hoping the tariffs would get cancelled. We have all seen tariffs being imposed, then they are pulled back. So the hope is many of the tariffs will not happen, so why would I raise my prices on the customers today? But if the tariffs are going to stay, and at least some of them are going to stay in place, by the time July, August, September come, you will have to react to it, and that's when I think, inflation will show up.
You think we're going to be in a stagflation situation like the 1970s. We have seen signs that the labor market is not as strong as it had been. That's why people are thinking the Fed should be cutting to satisfy that side of the mandate.
Well, that's what they thought in the 1970s as well. You had a president who was pushing Arthur Burns, the chairman of the Federal Reserve, to do it. And it ended up with stagflation toward the end. And we have a situation which is similar. The labor market, yes, it is weakening, but that does not mean that inflation does not go up. Because in 1970s, Becky, since you made the comparison, you had
I didn't make it. You made it.
I made the comparison. You had one commodity in short supply. It didn't have a substitute, and that commodity was called oil. Today, you have a group of commodities, put them in a basket, and there is no substitute for that basket because tariffs are going to increase all of them.
What is that group of commodities? Because the word we get from just about every expert we talk to is there's plenty of supply of oil right now. It's why you haven't seen oil prices spike even higher, even given the headlines that are coming out of the Middle East right now.
Oil is, yes, there is substantial, but you're looking at all the other imports, steel, aluminum, cars, where the tariffs are going to be put. And the car seller in the United States is not going to sell it without incorporating that cost increase in his or her pricing. So that is where I think one of those is going to come from. As far as oil is concerned, yes, there is ample supply, but we don't know about the political uncertainties, one being production facilities getting damaged, and second, what happened to transportation, logistics. The Strait of Hormuz could be closed with the Iranian presence, and about 30% of the world's supply of oil and about 25% of liquefied natural gas passes through it. And if that happens, you are going to see an immediate increase in it. Glut or no glut, prices are going to go up. Those are the uncertainties. I'm not telling you anything is going to happen for sure. Those are the uncertainties to prepare for. And this Fed is inadequately prepared for those kinds of developments.
So you're kind of alone on that side of things.
I am.
There aren't too many people who are kind of cautioning the same sort of issues at this point. Why do you think that is?
I think the market goes with the Fed. There is a general expectation that what the Fed knows best, it knows better than all of us. But I was trained from the academic side, as well as in my career, that the Fed has made so many mistakes. They go from crisis to crisis. And take again 2008. Before it happened, Ben Bernanke, the chairman, had no clue it was coming. He looked at it as a $50 to $100 billion problem, which he was immediately going to solve. And after September 15th of 2008, then there was a flood of liquidity, interest rates go down to zero, and they said Ben Bernanke saved the system. How about trying to prevent the crisis from taking place and anticipating it, rather than let the crisis happen and flood it with the market?
But that's not really the Fed's prerogative to a certain extent. It's supposed to be data dependent because we don't, as you point out, the Fed's often wrong. Do you want them making predictions on things that they think are going to happen on the data that might show up?
Good point, Becky. I agree with you. But data dependent doesn't mean you take the latest number and extrapolate it, assuming everything else is perfect. Data dependent today would mean nothing will happen in the oil market. There will not be any war. Iran and Israel will not go to war, and everything will be very calm.
Definitely.
And if that is data dependent,
it's an art, not a science. It's like, okay, we've had back-to-back negative GDP quarters. We need to maybe consider that we're slowing down. We have seen that we're in a recession. Now maybe we'll stop raising. I'm not saying they're doing that, but do you wait for 2 back-to-back quarters of negative growth before you acknowledge that you're
No,
in
but
a
then
recession?
you have people who are telling you, well, you should wait for the data because you guys are always wrong on every count.
And there's definitely a risk, but there's a risk either way. There was a risk in not acting preemptively. Right. That's why they're still trying to. They hate what happened when inflation got out of hand. It was a 40-year high in inflation, and everyone thinks it's their fault.
Yeah, my professor for my PhD thesis, John Taylor, is somebody the Taylor rule that I go with. It is rule-based. So when you're data dependent, Becky, what you're going to do is to have a formula that you follow to do that.
Right.
They won't do that because the Fed is a bureaucracy. They need their jobs, and they need to come to work every day.
They can ignore the data that they get and have that's when they can exert their own influence and their own personal bias about what the data is saying, and they still don't either raise or cut, and it could be wrong. Right?
Exactly.
It's not a job anyone wants. You don't want it.
No, but I don't want it. But then what I would do if I were the person doing it is to have an able algorithm, a computer, a formula.
Well, now we can do that with AI, right?
But now you can probably do that, but they won't let it come by because they all need to keep their jobs and to make speeches in public. And that is where I think the problem comes from.